Oh, excuse me 1 second, please. Good morning, all. Looks like we're drawing a pretty good crowd, huh?
Good
Hi,
morning.
hi, Philip. How you doing?
I'm good. How are you?
And Patty, welcome back, Patty.
Yep.
Oh, hi, Eric. How's my man from San Bernardino doing?
Pretty good. How's it going, Bob?
Good. Hi, Shannon. Welcome aboard again. I guess, is anybody going to show their face, or I'm going to be the only one sticking my mug out here? There we go. Hi,
There you go.
Patty. There we go. There's Eric.
Where's my full
All
screen?
right. Nastasia's coming in,
There we go.
and she usually shows her visage. Good morning, Nastasia. Does Nastasia want to show her face? Nastasia is muted.
Hi,
This is
Bob. How
hi,
are you?
Nastasia. Welcome aboard. Okay, we got the fighting five here today. That's a good crowd. All right, we're going to go into chapter 4 as we race through this course, and then Friday, I guess we've got chapter 5, and then Monday we've got chapter 6, and then the following Wednesday and Friday is your tests. You could have 2 separate tests, one on chapters 1 through 3 and one on chapters 4 through 6, okay? Know your debits and credits. Hint, hint, that's a big part of that first test, right? All right, here we go. Let me share a screen here. This chapter is actually a bit brief, but no less important for being so. Hold on here. Share screen, chapter 4. Let me make this bigger. What? Come back. Hold on a second, guys. Got to move this over. There we go. Set it up the Sheldon Cooper way. Okay, sort of a short chapter, but super crucial. We started the class by talking about what accounting is all about, the language of business and who uses the information. And we pretty much figured out that anybody with any interest uses the information. And we learned that the accounting follows the rules of GAAP, generally accepted accounting principles, as promulgated by the FASB, Financial Accounting Standards Board, which is an adjunct of the American Institute of Certified Public Accountants. Just those 3 acronyms we want to understand. Then in chapter 2, we did some basic entries, financial transactions, where we talked about plus and minus, up and down, increase, decrease. We spend money. Guess what? Cash goes down. When we got to chapter 3, though, we got rid of those words. Now we're never going to say, or we shouldn't be saying very frequently, increase, decrease, plus, minus, more or less. We're going to say debit, credit. And debit and credit simply mean left and right. That's all it means. And we have to understand that certain accounts are increased with a debit and certain accounts are increased with a credit. And those rules for the 5 line items, you just have to memorize them somehow, some way. Assets equals liabilities plus equity. That's our accounting equation. Let me turn this thing off here. That's our accounting equation. Assets have a normal debit balance. A normal balance means the left or right, which increases the balance. Assets have a debit balance. If assets equals liability plus equity, then that means liability and equity have a normal credit balance. A credit will increase that number. Revenues have a credit balance. Therefore, expenses have a debit balance. And we got to get to the point where we can roll through that. When I was in the classroom with this particular course, I'd have 30 people maybe, and we shoot like you. I'm a big sports fan. I'd say we're going to shoot layups. I go up and down, handing out an accounts payable, and you tell me that that's a credit balance. Okay. We learned about the T accounts, how the T accounts mimic the general ledger. Now we're going to show you in chapter 4 how the data, how that electric bill you got in the mail today is now going into your financial records permanently. And it's done by what your book calls general journals. The whole world calls them journal entries, okay? And they're talking about describe the flow from source documents to the trial balance. That's kind of what we're talking about to get started, huh? A source document. It means, in the old days, it used to mean a piece of paper. I have a piece of paper in front of me, and it tells me that this transaction has just occurred. Today, it can be a text, it could be an email, the notes from a phone call or something, anything that you can put in writing that generates a transaction. Most typically, you get a bill in the mail, you get an invoice in the mail. That jars you, it's time to record the electric bill. You receive cash from a customer. That's a transaction. Time to pay somebody. That's a transaction. So what they're talking about here is source documents, and we're going to enter them now into our general ledger. We're going to take these source documents and enter them into our general ledger, and we're going to post them, and then we'll come up with the trial balance again. All right. So let's see what we have here. The purpose of source documents. I think we understand what a source document is, and we don't need to go into any more detail on this. A source document is a trigger, triggers the analysis of what happens, and it begins the whole process. And guess what? It serves as objective evidence of business transactions. Now, typically, when I was a working guy before I became a lazy old guy here, the source document would be stapled to the back of your journal entry, which we're going to learn in this chapter. You would prepare your journal entry in your computer. Even then, we did have some computers. You put them into the mainframe computer system, and you would print out the journal entry and staple the source document to it. A year later, the auditor comes and he says, what's this $340 all about? You're not going to remember everything that happened. You go back, you find the entry. Here it is. It was the payment to Eric's company. We had to pay him in advance for some reason. And like it says here, you file them away. What are some more examples? Check stubs, cash register tapes, sales tickets. My goodness, we're beating the heck out of what a source document is. We know what a document is. Now let's talk about the chart of accounts. You've been using it all along, whether you realize it or not. The chart of accounts is a list of the different folders, let's call them, that a company sets aside that they want to isolate and record activity into. Cash is always going to have its own folder. Accounts receivable. You get to something like electric bill. Well, some companies have a separate account in the chart of accounts for electricity, and some say, well, let's include electricity, gas, and water all in one, and let's call it utilities. It's up to the company what they want to isolate. The chart of accounts. And typically, just as a general rule, you want to minimize the chart of accounts. You don't want to start setting up the chart of accounts for every little type of expense that comes in. For example, the Boy Scouts came to your company store and you bought $100 worth of cookies from the Girl Scouts, say. You don't want to set up an expense called Girl Scout cookies. That would be ridiculous. You'd have a cluttered chart of accounts. So you just have an account maybe called donations or something like that. Chart of accounts. It's used by all businesses. It shows all accounts used by the business. It is in numeric order. And it's used to determine which accounts are affected by a transaction. When we say numeric order, typically the chart of accounts will begin with not typically, they always begin with assets, followed by liabilities, followed by equity, then comes revenue, and finally expenses. That is the order of the chart of accounts. There are no exceptions to that. The numbering system is typically 1 if it's an asset, 2 for liability, 3 capital, 4 revenue, 5 expense. Okay, it goes in that order. And here's a look at a tiny chart of accounts. So let's get a little bit familiar with this, huh? Mitchell's Campus Delivery, huh? Well, he has a small business delivering pizzas to different campuses around here. Notice that it begins with 101, and that's very typical, 101. Now, a 3-digit code, you could have that. You could also have very complicated codes. When I first went to work at Thomas and Betts, I looked at the chart of accounts and it was like 15 numbers long. Typically in the expense area, you would see something like 520, and that was utilities expense. Then you'd see -00, and that meant it was domestic. -25, it meant it was New Jersey. -2222, it meant it was electric of some. Anyway, they can be very complicated. So here is a typical chart of accounts. Okay, the chart of accounts: 1, 2, 3, 4, 5. Here we go. Now we're going to perform what your book calls general journals, journal entries. Journal entry. The journal is a day-by-day listing of the transactions. Each transaction means one journal entry. One journal entry covers each transaction. Each transaction has to have one debit and one credit at a minimum. You could have one debit and 100 credits. You could have one credit and 1,000,000 debits, but you must have at least one of each. Otherwise, your accounting equation will go kshkratz. It'll be out of balance, okay? So we have this day-to-day recording of transactions, and we can call this the book of original entry. That's an old-fashioned term, kind of nice to see it again, because it's the journal that updates your general ledger. When we hit that button that says post in QuickBooks or Mass 90 or whatever form, whatever software you might be using, that's a permanent record we've just put into the general ledger. And the simplest journal entry form is 2 columns, one for debit, one for credit, and then a column for an explanation. So let's see what is in every journal entry. Every journal entry has to have a date. We got to know when this thing happened. We have to put the title of the accounts. We just don't debit $100 and credit $100 and think that's going to fly. We have to understand that we're debiting cash and we're crediting sales. The amounts obviously are important. And the last part, they don't really ask for you to do all the time, but it's so super important. A brief description. Every single journal entry you write should have a brief explanation. And that explanation does not have to be a paragraph or a sentence. It can be just a few words. 99% of your journal entries, you can start the description by saying to record. For example, you got the electric bill today and you're going to pay it next month. So your journal entry, you debited electricity expense and you credited accounts payable. All you have to say is to record electricity expense. That's all you need to do. It needs to be short and sweet and to the point. And there are 2 reasons why this description or explanation is really important. Reason number 1, you are not going to remember just by looking at the journal entry what you were doing. You know, you're not going to remember that far back. So you pull the entry and you say, well, let's see here. We debited electricity and we credited accounts payable. I assume that's the electric bill. But you do want to look at the explanation. So the explanation provides what's called the trail to the auditor. The auditor can come in and see that $1 million worth of electric bill, and it'll say, show me what that was all about. You pull your journal entries, and the auditor can do his or her tests. That's an obvious reason why you put a description. But I'll tell you another one. As you get into more complicated issues, if you find it difficult to write, say a 10-word description, if you can't say to record the, and then boom, 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 do it in half a dozen words or so, that might be because your journal entry is wrong. If you have to start to try to sort of justify what you've just done, it's probably wrong, okay? Now, I think we have these darn transactions memorized, huh, from Mitchell. We did these transactions in chapter 2 when we were just plus minus people. We did them in chapter 3 by posting them directly to the general ledger, which is what the T accounts are meant to mimic. Now we're going to write the journal entries. The journal entries. You're going to go into your system and enter the module called journal entries, and the screen will pop up in front of you. And now it's time to do some work. So here we go. Mitchell invested $5,000. He's invested in this business 3 times. $5,000, right? Well, we know what the transaction is going to be. We went through that process before where they say, understand what happened. Well, what happened was this guy opened the business with his own money. So we know cash is going to go up with a debit and capital is going to be credited to increase that. But look at the template. What we're looking at is the template now. General journal. And then they have numerical rows here, which can be helpful. You always have to have a date. You have to have a date. You maybe only need to put the year on top, and everything below it is obviously part of that same fiscal year. The title of the account, cash, capital, you're going to see here. You might have a posting reference, which could be journal entry 1 or something if you want to number the journal entries, or it could be just the account numbers or something. And you put your dollars in, and then the third row will be an explanation. So drum roll, here is the start of your journal entry. We know we're going to debit cash, and you do want to make it a rule to start with the debits first. If you put the credit first and then the debit, that would not be wrong. You would get the same result, but it would make it difficult on people who are used to looking at these things conventionally and seeing the debits first. If you're putting the credits first without thinking about it, it shows that you're a little bit careless and you're not very courteous, because that's what the readers expect to see, debits first, okay? So cash is entered on the first line, $5,000 debit. Guess what? We're going to have a credit for $5,000, a $5,000 credit, Mitchell Williams Capital. The title of the account to be credited, Mitchell Williams, goes on the second line. Notice the indentation. Super, super important. On every journal entry, without exception, credits are indented. It's another way that allow readers, auditors especially, to go through your information pretty quickly. If you don't do that, it's just a mishmash of line after line after line. This breaks up each entry into more readable formats. So that goes in the credit column. And see the explanation now? Well, we know what happened. Mitchell opened the business with cash. The explanation here is owner's original investment in delivery business. To me, that's much too long, to be honest with you. To record, I would just say to record owner's original investment. And I'm not even sure you need the word original, to record owner's investment, okay? Now you skip a line after that. Don't jam the journal entries on top of each other. Some journal entries have more than one debit and one credit. Remember when we sold something on account and nobody had money, and the person was able to pay a little bit up front, and we debited cash for the amount of cash we got, and we debited accounts receivable for that amount of the difference, and we credited, say, the 1,000 to revenues. And an entry requiring more than one debit or credit is a compound entry. Compound entry means more than one debit, one credit. And again, put your debits before the credits. Can you see this, Nastasia? Can you read these numbers?
Yep.
Okay. I'm assuming you can all read them. There could be one exception here, and you know who that is. Yeah, you guys are hundreds of miles away from me and you can read it. I'm right on top of it. I can't read it. Okay. They're just showing you some of the journal entries. Apparently, they're going to be merciful. They're not going to make us do every transaction over again for the third time. These are the transactions we've already done twice. So look at the journal entries. Supplies. I'm sorry, I got to do this real quick. There it is. Supplies, we bought supplies on the 16th of June. We debit supplies, which increases the asset, and we credit another asset called cash. Purchase supplies for cash. If it just said to purchase supplies, that would be better, I think. Then what happened on the 20th? Well, the explanation says received cash on account, and it's even telling you from the library and School of Music. Normally, you don't go into that kind of detail with the journal entry. You can if you want. You could write paragraph if you like. Here, a lot of detail. Received cash on account. Well, we sold something to the library and to the School of Music a couple of months ago, and now they're paying us. So we debit cash for $1,900, and we credit accounts receivable. Now what? Oh yeah, I was just kind of joking to myself. The library and School of Music. Those people eat a lot of pizza, I guess, the School of Music, okay? On the 25th, delivery equipment. We bought delivery equipment. There is a compound entry. A compound entry means more than one debit or credit. We bought the equipment for $1,000. We received $300 in cash, and accounts payable. Purchase scooter with that. Yeah, then accounts payable went up. Yeah, we purchased the equipment for $1,000. Accounts payable is the amount we're going to collect later. We did collect $300 up front. Prepaid insurance. Prepaid insurance. We pay it in advance. Prepaid insurance, just like supplies, is an asset. Those are assets. It becomes an expense only when we get to Chapter 5. Or when we're actually going to use the insurance, when we actually get coverage, okay? We debit prepaid insurance, credit cash, wages. So just take a look at these journal entries. Imagine sitting in your office and you're recording the payroll. You probably got a nice big printout from ADP, or you got a printout from your own in-house payroll system, however you're doing it, or maybe you're doing it in Excel if it's a small company, and then you've got all the information and you're looking at that and you're debiting salaries expense, wages expense. You could have a whole bunch of salary expenses. You could have salary expense dash sales dash admin dash hourly work, whatever. You debit wage expense, credit cash, and you're paying your people. And there's another compound entry. And then finally, Mitchell with his famous drawing, okay? Anybody have any questions, any thoughts on the journal entries thus far? Am I going too fast, too slow? If you can't hear me, let me know, okay? So now we have these journal entries. All we've done so far is just enter the information into QuickBooks. That's all we've done. Nothing happens at that point. Zero. At the end of the day, we may say, okay, QuickBooks, we're done with today's journal entries. We'll see you tomorrow. Your general ledger has not been impacted yet because we haven't posted. Post. That's a word that means we're taking a number, a journal entry, and we are putting it permanently into the general ledger. Permanently. We are taking that journal entry and making it part of our financial statements forever, forever. Let's let this guy back out. I'm sorry to say something silly, but that garbage truck driver amazes me. This is a very, very narrow twisting passage behind my place here. And that guy just backs out like at 20 miles an hour. Just incredible. I've banged my own car like 8 times into that wall maneuvering, and this guy can do that. Where was I? Did I digress? We were talking about posting to the general ledger. What's the general ledger? Okay. The general ledger is a glorious T account. It looks like a couple of T accounts side by side. The general ledger are what you call the complete set of all accounts used by a business, similar to T accounts. This is where you keep a complete record of the debits and credits to each account, and as a result of the journal entries. And they're numbered and arranged in the same order as the chart of accounts. In other words, when you print your trial balance, it's going to come out the same way. Assets, liabilities, equity, revenue, expenses, in that order. You ever hear the expression, the books? I want to see the books of the company. That crook was cooking the books. That's what the general ledger is, the books of the company. And the word general is meant very specifically. It just gives you very, very general information. Not a lot of detail. You look, and you'll see in a moment, you look at the general ledger for cash. All you're going to see is the beginning balance of cash, the next receipt of cash, the next disbursement, and then off to the right, the running balance. It's not going to give you much detail, but that's where the auditors begin. They're going to come into your business and they're going to say, okay, I'm going to start with cash today. And they say, Shannon, how much money you have in the bank? And you say, I have $1 million. Is that good enough for you? And the auditor says, no, we need more than your word. Show me the general ledger. General ledger says you have $1 million. Well, that's just a start. The auditors are then going to say, I want to see your bank statements. I want to see your bank reconciliations. I want you to sign off on this note, giving the bank permission to tell me what some of these transactions were about. Only after they do a whole bunch of tests do they bless that your cash balance is correct. Auditing that way is called auditing from the inside out. I believe that's inside out, not outside in. They start right at the highest general ledger level and then work their way back, detail, 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 until they've performed enough policies and procedures based on GAAP to satisfy themselves that your cash is good. They'll do the same thing with accounts receivable. You tell them you have a $2 million in accounts receivable. Well, that's a good starting point. You're then going to show them the list of all your customers. These are the people who owe us the $2 million. Then they're going to have you write a letter to those customers asking them to verify these balances only after a bunch of tests like that. So the general ledger is general. So let's take a look at our first general ledger. Chapter 3 on the left, you may remember this. That's all the cash transacting that was done by Mitchell Williams during this month, whatever month that was, June. Okay. Remember, he had a beginning balance of 5. He put the 5,000 in to begin. Then B, he bought some equipment. C, he bought more, or C, he went out and sold something, got more cash. You get the idea. The cash is all limited right there. That's our general ledger. Look at the general ledger now. You can just copy this T account over, and there's your general ledger. There's the general ledger. And take a look at the ledger. You're going to have one for each account, one folder for each account. Think of these as folders. And it's going to have the dates of the activity. You could have an item here if you chose to put something in, some kind of note or something, posting reference perhaps. But take a look at your general ledger. We started off with 5,000, just like here. And then we had the 2,000 and the 600 come out. So take a look at it, if you can. Debit $5,000, that's the balance. But then we spent 2,000. What was the balance after that? 3,000. We spent 600. The balance is 24. We brought in 2,100. You get the idea? So your general ledger, think of it as two T accounts side by side. The first pair represents the activity. The second pair keeps the running balance. And you notice you see nothing on the credit side here with the running balance. Why is that? Because the normal balance of cash is a debit. The normal balance of cash is a debit, and the normal balance represents the side of the T account, left or right, that increases. Debits are on the left, so debits increase cash, credits decrease. If you ended up at the end of the month with a negative balance, I don't want to say negative balance, forgive me. If we ended up with a credit balance at the end of the month of $470, there's something clearly wrong. You can't have negative cash. The only way you can have negative cash is if you haven't recorded a certain transaction, or a mistake has been made, or more likely you're floating checks, which a lot of us do in our personal lives. Hopefully I'm beyond that, but you know what I mean by floating a check. This company only has $470 in the bank, but their $2,000 rent check is due tomorrow. So they wrote a check for $2,000. They put it in the mail in the hopes that over the next 2 days, they'll be able to cover that check. That can drive you into a negative. Auditors don't like that. I've been forced to do that on rare occasions, and I catch hell from the auditors. And my argument is, oh yeah, buddy, you sit here and tell these people you're not going to pay them. That's how you can end up with negative cash. So get a good look at that general ledger. When do you post to the general ledger? You do it you do it when you want. Let me put it that way. You're going to put together a bunch of journal entries. Maybe you're the new guy in accounting and you've been hired out of UCSB and you're given the title of junior accountant. I don't know if they use that expression, junior accountant. And you know what a general ledger is, and you know what posting's all about. You understand the general ledger and the chart and everything. And they give you a bunch of transactions to record. You're the new guy. So you sit down and you start entering, and okay, this is the electric bill. I know what to do with that. This is the gas bill. Oh, here's an email from my boss telling me that he wants $100 donated to the local Little League. You put all those entries in. But maybe your boss said, don't post them yet. Don't post them. I'm going to check you out first. The point is, you enter the journal entries, but before you post, please double check. The double checking may not take very long at all. But if you make a mistake, it's there permanently. It cannot be removed. It cannot be removed. All you can do is correct it, most properly by reversing it. And an old friend of mine, a guy named Charlie, many years ago with our clunky system, he meant to put in $100, and you had to put it in 100, and you actually had to go decimal point 00, and somehow he thought the number was like 10,000 instead of 100, and he missed the 00. He ended up putting in $1 million. And as soon as he hit the posting button, we heard him yell. And I came walking, what's up, Charlie? He shows me the million. Anyway, it was no problem. We just reversed it immediately. He went in, he did the entry backwards. But the point is, forever and ever, that $1 million number stands out like a sore thumb and attracts attention. So you post these journal entries when you're pretty sure they're ready to be posted. Don't let anybody rush you. It's done typically daily. That's about right, I guess. Or once a week, or whenever you want to do them. It's totally up to you. 5-step approach to post. Enter the date of the transaction in the date column. Well, they're telling us how to write our journal entry here. Enter the balance. There we go. Enter the journal page in the posting reference. Remember the posting reference column we were talking about? This could be J-20, meaning these are the journal entries that were posted on January 20th. It could be something as simple as that. enter the journal page in the posting reference column, enter the ledger account, and off we go. So take a look at the journal entry, and now take a look at the general ledger. The journal entry, the general journal, that's your mechanism for updating the general ledger. You debited cash in your journal entry, and you credited 5,000 here for Mitchell Capital, both increase. See what they're using as the posting reference? The account number. You can do that. Remember our chart of accounts, accounting cash began with 101, accounts receivable was probably 102. So that's what they're choosing to do. This could have been whatever they wanted to put in. They could have put in June 20th or something. And here is our general ledger. After the very first transaction, we put 5,000 in the bank, and that's the balance. Posting a debit, posting the debit side. Let's see the other half of that transaction. Oh, heck, they get us all excited that they're going to show us posting the credit, and then they don't do it. I feel let down. But they said posting a debit, you would post a credit as well. And you'd see another page called Mitchell Williams Capital, and you see the 5,000 on the credit side, huh? Now, after we posted everything. We posted like crazy, right? At the end of the month, we've posted everything. Now it's the end of the month, and we're ready to prepare our financial statements. The first step in doing so is to come up with the trial balance. And we introduced the trial balance in chapter 3. The trial balance is just a listing of the debits and credits in chart of accounts order, and that's very important. And all this report does for us is tell us that debits equal credits. That's all it does. You're not gonna have to worry about that in the real world. Debits equal credits. And you prepare it after all the transactions are in up to that point. You can run this thing every day if you wanted to. I've never seen anybody do that. You can do it every week, month, whatever, but you certainly need to do it at the end of the last day of the fiscal month. And here's our trial balance. We saw this in chapter 3. We're getting these numbers exactly from, the journal entries that were posted. We're pulling them right off the general ledger. So as you can see here, we list the accounts beginning with cash, 101, whatever. Here are the account numbers here, 101, 122, 141. Debit, credit, make sure you put them on the correct side. Accounts receivable has a credit balance. Capital has a credit balance, but drawing has a debit. That's our outlier. Okay, we're in balance. Hooray. Does that mean we're ready to prepare the financial statements? Not really, but in chapter 4, we're going to pretend that this is all correct. What you're going to learn in chapter 5 is that there's a whole process of adjusting and correcting this trial balance. And we'll get to that, I guess, on Friday. How to find and correct errors. I'm not going to spend too much time on this. Double check your work. Even though the trial balance indicates the ledger's in balance, the ledger can still have errors. That trial balance we just looked at, that thing could be 99% baloney. It could be all wrong. But our debits equal credits. That's all it's telling us. And how could it be botched up? Well, if you debit or credited the wrong account, or you put it in the wrong side. So be very careful in posting. Guess what? We kind of knew that, huh? Double check your addition, review the balances, see if anything is too large. Yeah, look for an exceptionally large number. That usually indicates a key punch type error, or data entry error rather. Subtract the debits from the credits and look at that number. Then look at the numbers you have. It might indicate you put something in twice, or divide that difference by 2. These are little tricks. The only one that's worthwhile, really, and this is pretty good. This is probably not important to you guys in your modern world, but this was what we used a lot. The difference of 9. You guys have a calculator? Put a 2-digit number in. Put in like 87, if you don't mind. Put 87. And then subtract 78. You notice the difference is 9? Difference is 9. Put in this number, please. Put in 361 and then subtract 316. You notice the difference is divisible by 9? Came out to 45, right?
Okay.
Now, you may be saying, why am I being taught this? It can be a help. It was a big help in the old days when everything was done in pencil. You would add all these numbers down. You might have 100 numbers and you got the adding machine tape going. And by the way, I was the world's fastest on an adding machine, but we were all fast in those days. You add it down and you're off by $90. You're off by $63. You're off by $36. That might mean you transpose 2 numbers, meaning you put one in front of the other by mistake. If you think it's a transposition error, it makes things a lot easier by just running your finger down the numbers, and you might find the one that pops right out. In other words, you've got your adding machine tape and you're going down, whammo, there's the difference right there. It was a transposition error. Something I'd just like you to know. I mean, you know, maybe you go to a bar and women are very impressed when you do these math tricks I've learned over the years, okay? So hopefully this will do you some good. Again, your trial balance is never going to go out of balance, but there could be reports you're doing in Excel, right? You're putting together a payroll, and then the payroll comes out, and all of a sudden the gross pay minus the withdrawals does not equal the net pay. Well, it has to. What went wrong? Maybe you go through it, you look for that divisible by 9 trick, okay? I have other tricks I can show you too. They're more along party tricks. Be an exciting party. You come to one of my parties. If the tips don't work, you're screwed. That's all there is to it. If the tips don't work, double check and just kind of have to start over again, trace everything you did. If the tips don't work. Correcting errors. Oh, geez, all this on correcting errors. The first item here is very important. You never erase. You never erase. Make the correction in a manner that's easy for others to observe and understand. I certainly would demand that the only correct way to do it is to reverse the journal entry. If you debited capital and credited cash by mistake when Mitchell began the business, you find your error, then reverse that. Put it in correctly, and then put it in correctly the second time so you have it set up there. I don't like correcting things by putting the difference in. That can cause a lot of problems. And I got burned a few times of that many years ago. I can go into great detail on that. I won't do that right now. A new entry must be made to correct. Now, they're just going to give us an example, I suppose. A 400 payment, now they made a mistake. They debited repair expense by mistake, but correctly credited cash. You need to get the 400 out of repair expense and into rent expense. So guess what they're going to do? They're going to credit the rent expense, I bet, and debit repair expense. Well, we'll never know because that's the end of the chapter. But what they're saying here is to correct this. You see that debit for rent expense and that credit for repair? That should have been reversed. What they're telling you what they're going to do is they're going to debit repair expense probably for $800 and credit the rent expense for $800, for $400 to make it correct. That's not a good way to go. They're going to take this and double it. They're going to debit repair for $800, credit rent for $800, and then say, we fixed it. Yeah, you fixed it, but it's going to be a little bit harder for people to follow. The better way to do it is reverse this, and that gets everything back to 0, and then you put it in correctly, okay? So, welcome to the world of journal entries. And you know I like to go around a little bit. Patty, what do you got going for us there? Anything?
I don't think so. Not really.
Not too tough to follow so far, I hope, huh?
Yeah.
How about you? How about you, Eric?
Well, it was pretty basic. I mean, especially since related to the last chapter with the T accounts and all that, and then I just apply that to the ledgers and all that. It was actually pretty easy to follow. I liked it.
Yeah, starting to tie it all together, right?
Yep.
Okay. Who else is out there? Hi, Shannon. Any questions?
I don't know how to use this.
You're okay, it sounds like. Did I hear you say you're okay?
Yeah, sorry, I'm not sure how to show my screen, but I think I understood everything.
Okay, that's a good sign. Philip, any questions, Philip, or comments?
I'm good. I'm
Okay.
following along.
Hey, Blake, how you doing? You're mute, Blake. Can I hear you? Blake is mute. Oh, maybe she can't. Where's Blake?
Sound like Popeye.
Yeah, it is my Papa. Okay. Okay, Blake, I guess can't hear me, but that's okay.
All right, I'm here. I'm unmuted. It makes
Okay.
sense.
Okay, Blake, what are the first of the 7 questions you must have?
I'm doing okay on this one.
Okay, not too bad, huh?
Not too bad.
Oh, that's Blake from Saturday, right?
Yes, hi.
Oh, wow. Can I tell them a little story about your son?
Oh, wait, I don't think that was, oh, yeah, sure.
Blake had a real empty nest moment Saturday. She took her son to the airport and he went off to college in Alaska, of all places.
That's right.
How'd that go okay, Blake, that
Yeah,
trip?
he's doing well.
Were you teary-eyed?
Adjusting. No,
Yeah.
I'm happy for him. I think it was time.
And happy for you too, right? You got the house to you and your husband. Okay. All right. Anybody have any questions? Then I guess we'll let us go, okay?
Okay, sounds good.
All right, we'll see you all on Friday. And then that'll be like a test prep almost, huh? Because we got 2 tests next week on the
Yep.
first 6 chapters, okay?
All right.
Sounds
You
good.
take care, guys. Thanks for being here.
Thank
Have a
you.
good one.